Hi, everyone. Welcome to today's webinar brought to you by Orient Futures Singapore. We are happy to invite our Senior Analyst from our Shanghai Orient Futures office, Ms. Mindy Xu, to give us an overview of the iron ore market outlook of the second half of this year. Let's welcome Mindy, please.
Thank you. Good morning, everyone. I'm Mindy from Orient Futures. Welcome to our conference call to discuss the iron market in the second half of 2023. Firstly, we will look back to the first half of the year. As you can see, the picture trend during H1 of 2023 is quite similar to the trend of it last year. Since our government lifted the control in last November, the iron market showed a very optimistic emotion on the economic recovery in 2023. This market sentiment can be found in many assets, especially in the stock market. Under this good expectation, the Platts index increased from $80 per ton in last November to $130 per ton in early March this year. However, we only see a very short demand pulse in middle of March. The market until now still didn't get the expected stimulus policy, and the steel demand fell back to the level before the reopen. After the disappointed demand performance and steel stock reboot, some millers cut their steel production and pushed the steel and iron price dropped to $90 per ton in this May. Now the steel market returned to stable in this June, and the iron price increased to $115 per ton again, along with some stimulus policy expectation in July's Politburo meeting. However, we think this price rebound is very hard to break through the price pressure level, maybe about $120 per ton. Now we will move on to supply and demand slides in H2. We keep the iron yearly supply growth as it at the last end of the year, which is about 30 million tons year on year. And we can see on this picture, the iron supply growth during next 2 to 3 years will remain at 30 to 40 million tons per year. As we all know that there are no large-scale projects going to operate during next 2 years. However, it is worth noting that the shipment volume increase this year mostly came more from Australia or Brazil, and we are pretty to say that some non-mainstream countries such as India and South Africa showed an unstable shipment supply. Let's take India as an example. We can see this picture on the screen, this picture. From this January to April, India's monthly was approximately 3.5 to 4 million tons per month, but it dropped to 2.5 million in this June for some weather reasons. Also, we can see South Africa for another example. Iron export volume is decreasing because of strikes or transportation restrictions. That means although we can see some shipment increase during 2023, but most volume comes from the big suppliers such as Australia and Brazil, and the concentration of major suppliers remains high as usual. Then we take a look at domestic iron supply. Chinese domestic iron growth showed another disappointing year again. Using some data inversion, we can find a clear conclusion that there is some domestic iron growth in 2023, but this amount seems very limited. And due to environmental or safety supervision, the operating rate of domestic iron mines seems lower than before. Now, let's go over to the demand side. To be honest, Chinese steel demand now is much better than everyone's expected before. We see most micro indexes, such as the property's new floor space or PMI, are all on the way of deteriorating. But the steel demand itself is much more stable. According to our steel team's estimate, or this Bloomberg's estimate, or just the apparent assumption number, all show that in 2023, the crude steel demand is expected to around 0%. That means, although we see property's new floor space drops about 40% for 2 consecutive years, the crude steel demand itself didn't shrink too much. That is a little surprise for most of us. This resilient domestic steel demand may come from many aspects, such as energy, shipbuilding, factory investment, and of course, the big steel export. Miners resumed their production on recovery of the margin. Since the beginning of June, MySteel's peak on weekly production increased from 2.37 million tons per day to 2.45 million tons per day. Along with the production increase, most plate millers are still feeling comfortable on their July's order. Our survey also showed that most steel millers' lead time are more than 2 weeks now. That means there is still not too much pressure for the demand side during the short time. Another factor that supports the iron demand is the shortage of scrap, again, just like last year. With lower machinery production and the supply of scrap showed a little bit lower than last year, which may be 10,000 per day, 10,000 tons per day than last year. Under the assumption of same steel demand and less scrap, we can see this screen, which is displayed in the last column. The market balance of pig oil is around 2.3 million tons per day during H2. This is a number much higher than market expectation before. So we see the demand in China seems better than our expected. However, the iron demand outside China showed disappointing during H1. We saw JDK's pig oil production. That means Japan, Taiwan, and Korea's pig oil production comes 3 point percent lower than last year, and European product 10% lower than last year. And the economic recession become even more clear in some developed countries, which can be represented by PMI. All this pushing global steel price to a low level. So global export steel price may become a price cap for Chinese domestic market. These are the demand side. Now we can finally get to the supply and demand balance sheet. As you can see on the screen, with the assumption that supply grow over 3,000 tons year on year, and China's crude steel production unchanged, but with less scrap and more pig oil. That means the pig oil in China increased a little bit than last year. and JTK and Europe maintain their produce reduction speed, we can get a market surplus around 6 million. This is a number less than 10 million tons surplus in 2023, which we all think that this is a big pressure for iron price, and the market will keep balance during H2. So we can make conclusion now. Firstly, iron has no independent trend this year. All the market change come from better or worse steel demand or metallurgical price movement. Secondly, the iron price is on a large range of fluctuation now, with the range from $80 per ton to $120 per ton. That means the Platts index now, we think, is not cheap right now. So here comes the question. How can we measure the market is overvalued or undervalued? There are two ways, we think. We suggest to take the miller's profit and export steel price as the references to measure the market level. During last 10 years, Chinese miller profit mostly fall in the range between negative 150 to 100 to 200 per ton. Without a sustainable demand recovery, we can use miners' margin to value the market. Also, as steel price remain weak in overseas market, the domestic steel price will face price pressure over 3,900 yuan. So here are all the points we discussed today. Now we can go to the Q&A session. Thank you.
Okay, thank you, Mindy, for her valuable insights. Now, let's go on to our Q&A. So the first question from Mindy. Yes. What factors will most likely influence the market during the shorter term?
Okay, we can answer this question from two aspects. At this point, the market is eager to see some stimulus policy right now, which may be mentioned at the Politburo's meeting at the end of July. Also, to the fundamental factors, we still didn't see too much pressure from the demand side, as we have just presented. So we should wait to see the miller's order status in the August. So both factors are point to a potential market change in middle to late July, and it's better to wait and see now. And we are waiting for a chance to short.
Okay, thank you. The next question, can you share with us on the SGX and Dalian arbitrage?
Now, the Singapore future is higher than the Dalian active future now. And along with, we all see that RMB exchange rate depreciation a lot during short time. And the Dalian's future always have a deep discount for the spot. So we can try to buy Dalian's future and short Singapore's future. But we need to take attention that Dalian market may change their delivery spot benchmark to Jingbilba shortly. So our answer to this question is also need to wait during short time. But the arbitrage we can wait is to buy the Dalian and short Singapore in future.
Okay, thank you, Mindy. With that, we come to the end of our webinar today. Yeah, if you'd like to find out more, you may visit our website or contact us at support@orientfutures.com.sg. Yeah, thank you, and we hope to see you at our next webinar. Thank you, Mindy. Thank you.
Thank you. Bye-bye.
Bye-bye.